Hi everyone, Jim Lorenzen here, and we're going to start this session with a brain teaser. Okay, Bill is retired. He has taxable income of $46,138. That's his taxable income, and you can see on the chart on the right there, that puts him right in the middle of the 22% tax bracket. Now that income, that 46,138 includes 38,000 in IRA income plus 37,500 in Social Security benefits. And the way the tax code is structured is taxable income comes down to 46,138. Okay. He decides I'm going to tap my IRA for an extra $1,000 and go to a concert on a concert road trip. So he takes it out of his IRA, that's taxable income, but he's in the middle of the 22% tax bracket. So how much tax do you think he owes on that extra $1,000? Well, the logical answer is he's in the 22% tax bracket, so it should be 22 cents on the dollar. Should be 220 bucks. Doesn't that make sense? Well, no. Believe it or not, that extra $1,000 means he's going to owe $407 in tax on that $1,000. That's a 40.7% tax rate on that income. Why? Well, thanks to the madness in our tax code and the unique formula that determines how your Social Security benefits are taxed, the real answer is that Bill is going to owe $407 on that extra income. Surprise. Welcome to our presentation, How Tax Planning Changes Through the 4 Stages of Retirement. I think when you go through this session, you're going to be a little better informed about the challenges of retirement tax planning. And you're probably wondering, well, why is a financial professional giving a presentation about retirement tax planning? Well, the answer is simple. Mistakes mean more taxes. More taxes equals less money for retirement. The money's either in your cash register or it's in Uncle Sam's. So, we're going to unravel this complex topic somewhat. At least we're going to try. And if I get tongue-tied from time to time, I want you to forgive me because it is a complicated subject. But each key of the 4 keys we're going to discuss builds on the previous one to form a solution to our presentation problem, as you'll see. Okay. Now, it's very important for you to understand that everybody's tax situation is different. You should always consult a qualified tax advisor to discuss your specific tax situation, especially about these topics. Traditional IRAs, they're tax deferred. You must pay taxes on distributions or conversions at ordinary federal and state rates. Roth IRAs are non-deductible. Money grows tax-free and earnings can be withdrawn in accordance with the IRS rules. State taxes, well, we're not going to talk too much about those because this presentation is about federal taxes. You still may face state taxes. You got to talk to your tax professional. Now, what I do, of course, I'm a financial planner. I'm a certified financial planner. Yeah. Anyway, I help people understand how the tax code and other rules can impact their financial planning and their investments. And I help clients develop a plan to take into account the many odd things that they're going to encounter around taxes and retirement. But first of all, let's get some housekeeping out of the way. I am not an attorney and I am not a CPA. So you want to get the right advice from the right people. I am a certified financial planner and I'm an accredited investment fiduciary. Nothing you're going to see or hear today is advice. It's only information that leads to education. So you don't have to become an expert on everything that we're going to be discussing today. All you have to do is just kind of jot down the things that you think may apply to you and discuss them with the appropriate professionals. A little bit of my background is up there on the screen. Down at the bottom, you can see the website, indfin.com. And if you want to learn more, go to our website, and I'll be happy to meet with you if you were interested in doing that. All the information you want to know is up there. Okay. Our goal is to help you understand the retirement distribution game. Spending assets in retirement. It's a lot different than the accumulation game you've been going through for the last, what, 20, 30 years? The accumulation phase was easy. You just keep throwing money into your retirement accounts, and volatility goes up and down, but you keep throwing money. It's long-term dollar cost averaging, and sooner or later you end up in retirement and you've accumulated a nest egg. Pretty simple. Just keep throwing money and accumulate. Don't try to trade, just accumulate. But retirement is different. The distribution phase has new and very strange rules that can catch people off guard. And along with those new rules, there are often many changes in your own personal life that go along with it. So you got changes in tax rules, changes in all these other things, interest rates, inflation, all of this. And then on top of that, your life goes through changes too. For example, now your children are grown, maybe. That means no more child tax credits. Your house might be fully paid off, no more mortgage interest deduction. And if you've already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you stopped working, you may no longer have the ability to stash income in a 401k to manage your annual tax bill. And at some point, you'll start taking Social Security. And sooner or later, when you reach age 72, you'll have to start taking RMDs, required minimum distributions. So, at this point, you're probably thinking, okay, what's the first thing I need to understand about retirement and taxes? Well, that takes us to our first key. You have to know what your after-tax retirement savings picture looks like before you retire. You know, a $500,000 401k IRA balance isn't really $500,000. Depending on your tax rate, Uncle Sam has a claim on some of that money. When you think about it, you're in the business of living, but you have a business partner. Your partner is your Uncle Sam. The only difference between this and most business partnerships is in this partnership, it's your partner who gets to decide how much you get, and he can change the rules at any time. You see, taxes weren't just deferred. In fact, let's look at it this way. Your taxes weren't deferred. They were merely delayed. Think about that. Because when you're forced to start taking required minimum distributions after you turn, say, I think it's age 73 now with the new Secure Act 2.0 in, obviously, your account is going to be worth less than what you see on the statement because some of that is Uncle Sam's money. Here's an example. This chart shows you the cumulative after-tax amounts you can expect to receive from a $500,000 IRA earnings that's earning 6% a year at various tax rates. Now, as you can see, the lower your tax rate, the more you keep. Very simple in theory, very difficult in practice. Now, by the way, this presentation, I should mention, applies to both pre-retirees and retirees. So don't worry if you've already started retirement, because tax planning is important throughout your entire retirement years. Now, note the disclosure information down on the bottom of the slide. It's hypothetical. It's a 6% rate of return, and this is something, a 6% average rate of return is something that never happens. You won't get 6% every single year throughout all those years. In fact, you might be lucky if any one year comes to 6%. This is an average. And it doesn't represent the performance of any product or anything like that. Now, remember that ordinary income tax rates are going to apply to withdrawals from a tax-deferred investment because, as I said, tax-deferred means tax delayed. And at what rate? Well, that depends on what the tax rates are. Your partner, Uncle Sam, gets the only vote. You don't. An investor should consider his or her current and anticipated investment horizon, as well as the tax brackets when making an investment decision. That's very important. Now, you're probably thinking, okay, maybe my accounts are not worth as much as I thought because Uncle Sam's got his hand in my pocket, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay my health costs. But one thing you need to understand when you're creating your retirement strategy is Social Security and Medicare have their own tax traps, and you need to plan for this as well. Let's talk about Social Security and taxes. Let's go back to Bill. Remember our brain tease? We want to understand why he paid a much higher tax rate on that extra money he took to go on that concert trip, that $1,000. Remember, he had $38,000 of IRA income as part of his adjusted gross income of $61,838, and he has $37,500 in Social Security benefits. That puts him right in the middle, as we said, of the 22% tax bracket. He takes a standard deduction. But when we look at when he took that extra $1,000 IRA distribution, he got hit with about a 41% marginal tax rate on that $1,000. So let's break down what actually happens. First, remember, the only difference between the two scenarios is that Bill has taken out $1,000 from an IRA. You see, after that, in the concert trip column right there. Okay. So we see here that by adding the additional $1,000 of actual income, it increased both his adjusted gross income and his taxable income by $1,850. That's right, because of the way other things get taxed. That means for every dollar of income he actually received in that 1,000, he's being taxed $1.85. $1.85 for every dollar? How does that happen? Well, here's the deal. Depending upon how much other income you have, the amount of Social Security benefits that are taxed varies. For example, if your other income is low enough, all of your Social Security benefits are income tax-free at the federal level. On the other hand, if it's high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal tax rate is. Now, Bill finds himself in the latter scenario. His current income after the concert trip, for every dollar he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he must add an additional 85 cents of taxable Social Security benefits. Now, if you add that up, that's $1.85 taxable at his 22% rate for every dollar of additional IRA income he actually receives. Now, if you do the math on that, it actually comes out to a 40.7 real tax rate on the additional $1,000 of income. This is what's called the Social Security tax torpedo. It can impact single filers, married couples with even modest incomes at any stage of retirement. It's one reason that tax planning in retirement is so important. Let's talk about Medicare. Let's take a look at how Medicare and something it calls IRMA can impact some couples in the go-go years of retirement and beyond. The go-go years are those first early years when you're doing stuff. What's IRMA? Well, it stands for Income-Related Monthly Adjustment Amount. The emphasis is on income because it's a monthly tiered surcharge. Again, a kind of a tax that's tacked onto the people's Medicare Parts B and D premiums. But it happens only if you have income over $97,000 for singles, $194,000 for married couples. Now let's take a look at what this means in action. Here's George and Martha. High-earning married couple, both are Medicare Part B and D participants. Now, IRMA surcharges affect income from 2 years prior. That's important to understand. I'll repeat it. The IRMA surcharges affect income from 2 years prior, and this couple was on track for $306,000 of modified adjusted gross income in 2021, 2 years ago. But on December 1st of that year, George decided to sell stock he bought for $10,000 on July 1st of 2007. That's when he bought it. So he decided on December 1st to buy this or sell the stock that he bought back in 2007. He sold it for $11,000. The resulting $1,000 of gain was taxed at the 15% long term capital gain rate. But because of his income, there was an additional 3.8% net investment income surtax. So his total federal tax bill came to 18.8. Now, that 3%, that 3.8% investment income surtax is another tax that comes into play when your modified adjusted gross income, what they like to call MAGI, exceeds $200,000 for singles and $250,000 for married couples. So George and Martha owe $188 of tax on the gain from the sale of their stock. 18.8%, right? Of $1,000. Well, or do they? Remember, my definition of a tax is any cost that increases as your income increases. So George and Martha will owe more tax than 188 because the gain from the sale of the stock pushed them off the IRMA Medicare cliff. Now they're paying higher Medicare premiums. Let's take a look. Here's a Part B IRMA chart. That extra $1,000 gain pushed their AGI, their adjusted gross income, into the next premium tier that starts with income of $306,000. Well, $306,001. So now instead of owing $329.70 for each of their monthly Medicare Part B premiums, their Medicare Part B premiums go up to $428.60 per month. That's an extra $98.90 per month, $98.90 each. Times 2, that's $197.80 per month. For an annual total additional income-related monthly adjusted Medicare Part B premiums of $2,373.60. But it's not over. Because Medicare Part D IRMA charges are also impacted. George and Martha are going to owe about another $19 per month for their drug plans. That's an additional $460 for the couple over the course of the year. So, adding all the IRMA surcharges together for the year, George and Martha will each owe an extra $118 a month. That's another $2,834.40 for the year. I'm from the government, and I'm here to help you. Now, combine that amount with the $188 of actual federal income tax they would owe on their stock sale, and the total tax owed on the $1,000 of gain, that comes to $3,022.40. Now, guess what? We're now at a tax rate of 302%. Let me repeat that. 302% tax rate? Are you kidding me? Let's review. The stock sale was $188, 15% long-term capital gain, 3.8 for the net investment income tax for high earners. It comes to 18.8%. The extra income from the stock sale triggers new IRMA tiers, and the total IRMA surcharges amount to $2,834.40 for George and Martha. So the $1,000 extra income triggers $3,022.40 on $1,000. That's a 302% real tax rate. You see, being pushed into higher Medicare Part B and Part D premium ranges is actually worse than being pushed into a higher tax bracket. Because if you go over the regular tax bracket by even a single dollar, only those last dollars are taxed at the higher rate. But if you go over the Medicare Part B and D income levels by even a single dollar, you move to the next premium tier. It doesn't matter if you exceed the limit by $1 or $10,000. And that's what they call the IRMA cliff. Now keep in mind, your IRMA payments aren't determined by how much money you made the previous year, as I said a while ago. It's rather your modified adjusted gross income from 2 years ago. And that's another thing that catches people by surprise. They think it's all based on last year. No, it's based in 2023. It's based on 2021, 2 years ago. Okay. Making sure that you enroll in Medicare at the right time is a critical decision. If you bungle it, you get hit by a lifelong penalty. That's right. A lifelong penalty. To help you understand this, let's take a look at Jim and Ann here, both 68. Jim retired at 65 and retired at 66. Now, prior to her retirement, the couple had health insurance through Ann's employer. And they continued that after Ann retired because her employer offers retiree health benefits. Unfortunately, they didn't know that they had to enroll in Medicare Part B as soon as Ann retired. Even though Ann's employer offered free health insurance benefits, those benefits are generally paid secondary to Medicare after retirement. They're usually not paid first. But Jim and Ann didn't know that. They didn't realize it until it was too late. And thanks to the way Medicare enrollment periods work, they weren't able to begin coverage until the following year. Now, let's take a worst case scenario. Financial planning is all about planning for the worst, hoping for the best. Actually, you want the best and you try to make sure you achieve it. But it's good to know what the worst case scenarios are. In a worst case scenario, this could have resulted, what they did, in a gap in coverage for Jim and Ann if they had major medical needs. Say it comes up, Murphy's Law. But even in a best case scenario, because Jim and Ann missed their deadline to sign up for Medicare Part B, they'll each owe a 10% Medicare Part B base premium penalty. And guess what? It's for life. Now you can see how much that translates into real dollars. They owe $395 extra in 2023. And historically, we can estimate the premiums are going to be higher in the future. So that 10% penalty, for example, that's going to grow and grow too. Over the course of a lifetime, it could translate into a $10,000 mistake for the couple. Now, for simplicity's sake, we're assuming that Ann's retiree health insurance covers prescription drugs, so they don't have to sign up for Part D. Just know that there's a penalty for that too. Now, we've seen how Social Security and Medicare have their own tax traps. And they have their own unique rules and penalties. So if you're like someone who we've seen in this presentation, you may be asking yourself, what are the other tax traps I could be facing in retirement? Well, the rest of what we cover isn't like what we've seen with Social Security, Tax Torpedo, or the Irma Cliff. The public generally isn't aware of those tax squeezes. But we're going to see how the tax code in plain view can also snag retirees, especially when there's no planning. And that brings us to our third key. You have to plan how and when you will use taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. You can't be very haphazard about tapping tax-deferred savings. Timing is everything, and if you don't plan carefully through all the stages of retirement, you'll encounter unintended tax consequences. Let's take a look by first addressing the question I often hear whenever I am doing retirement planning. Well, which accounts do I spend first? Well, here's a common example. Sam and Mary, as you can see, they've been good savers and are looking forward to spending their retirement years traveling and seeing their grandchildren. And in addition to Social Security benefits, they have $450,000 each in IRAs, $60,000 each in a Roth IRA, and $300,000 in a joint bank account. And they want to spend about $8,500 a month. That's just a little over $100,000 a year. So where would you take the money from first? Well, most people first take the after-tax money in the bank. Then they take the tax-deferred IRA money. And then they go to the tax-free Roth IRA money. Now, this is conventional wisdom, and it's been promoted by many big investment firms for many years, and it's not a bad plan. But we know that conventional wisdom isn't always, and the key word is always, the best approach. One way to help manage your income both before and during retirement is to utilize Roth IRA conversions. Now, a Roth IRA conversion is a simple process that allows you to move money from an IRA or any other pre-tax retirement account like a 401k to a Roth IRA. Now, in general, the amount you convert is added to your income for the year, and it will be taxed at your rate. For example, let's say Jill converts 100,000 from an IRA to a Roth IRA. She'll have to add that $100,000 that she converts to her income for the year, and the conversion income will be taxed at whatever her rate is. Now, for that reason, it's a good recommendation. One of the very, very, very few recommendations you'll actually hear. Before you make any conversion, I recommend you talk to a tax professional. You want to make sure you're doing the right thing. Plan before execute. Now, here in an alternative approach, there are two key elements in the early years. Number one, use the taxable bank money for expenses, but also during the same period, accelerate IRA distributions during otherwise low income tax years, putting that money into Roth accounts. Now, as I record this, tax rates are on sale. If you like buying things that are on sale, this is the time to do it. Tax rates are low right now compared to what they were back in previous years, but the current tax law is going to be sunsetting in a couple of years. So it's a good idea to take advantage of the low rates. Maybe talk to your tax professional, talk to your financial planner. But you can use taxable bank money for expenses, but otherwise during that same period, use low income years, put that money, accelerate, I should say, the IRA distributions and put that money into Roth accounts. That's something you might want to talk about with your professional. This is called filling your tax bracket. It's an approach we'll discuss in a second. An alternative approach gives you more flexibility to use the Roth money strategically in future years. So it's a good alternative. Does it make a big difference? It could be. In the academic studies I've seen, this approach has been shown to increase portfolio longevity. Got my tongue in front of my eye tooth. I couldn't see what I was saying. This approach has been shown to increase portfolio longevity, and for how long your non-Social Security assets last before being spent, maybe up to 2 years. But it depends on the individual, and it depends how you drain your money. Big takeaway, of course, here is that you've got to plan all the way through retirement, especially how you handle your tax-deferred assets. And as we said, see your tax professional. Now, a conversion doesn't need to be all or nothing. One of the helpful conversion approaches I use with many of my clients, and I'm sure a lot of other advisors do too, is called filling up the bracket. Often you may find yourself in the middle of one tax bracket with room to add more income without going into a higher bracket. That's a good time. For example, in 2023, the 22% tax bracket for married couples filing a joint return goes from about $89,451 to about $190,750. If you file a joint return and your taxable income is $100,000, that means you could add another $90,000 of income without going into the next bracket. That's maybe a very good time to think about a Roth conversion and paying the taxes while you're at that bracket. Because tax deferred is tax delayed. And delayed means it'll happen in the future if you don't. And what are the tax rates going to be then? Well, if you plan to convert a large IRA, filling up the buckets one by one, year after year, over a period of time is often more tax efficient than doing the whole thing all at once. Instead, you can make smaller Roth conversions over a number of years, filling up your tax bucket each time. And that helps reduce the average rate you'll pay on the converted money over time. Now, some tactics you can use in managing income around tax brackets might include, for example, let's see, withdrawing tax-free money from life insurance policies to keep income low. If you have cash value life insurance and the death benefit is not that important to you, you can withdraw tax money from the life insurance policy. Why does it keep the income low? Well, because the first money you take out is return of principal, and there's also loans that you can take after that. And you should discuss that with your advisor as well. Another one is selling highly appreciated stock for low or no capital gain, if you can do that. Taking distributions from IRAs or 401ks to take advantage of a lower tax rate now. As you've seen, you can also consider partial Roth conversions as well. Well, there are also 3 other pre-retirement strategies to consider, but they don't apply to all people. First has to do with might be health savings accounts. Now, this will only apply to people who are covered by a high deductible health plan somewhere else. Another one might be for small business owners who want to be extra tax savvy and fund a company retirement pension plan. And for certain high income business owners, this can increase their ability to claim the qualified business income deduction. And as I alluded to a few minutes ago, don't overlook cash value life insurance. In today's advanced designs, life insurance isn't your father's life insurance anymore, and they can have significant lifetime benefits. Remember, think of it, it's life insurance, not death insurance. Now, all of these features of the tax code could be used to manage tax exposure and provide significant benefits throughout retirement. But it's important to note, while we've seen the critical importance of managing the tax-deferred accounts, at some point you're going to be forced out of requirement to take out required minimum distributions, RMDs. And that can be troublesome because tax-deferred, as I said, is tax-delayed, and when you're forced to take RMDs, you don't have a choice. If you don't do those little conversions now or advance when taxes are on sale now, you will be forced to pay later when you don't have a choice, and you'll have to accept whatever the tax rates are. Many people make charitable donations, supporting their favorite nonprofit with annual gifts. Let's take a look at how RMDs, your required minimum distribution, and charitable giving may work for you with some tax planning. Here's Albert and Shirley. They're in the 24% tax bracket. Now, the standard deduction for a married couple filing a joint return in 2023 is $27,700. But Albert and Shirley are over 65, so they get an additional standard deduction, bringing their total deduction to $30,700. Wow. That means they'll receive no tax benefit for any itemized deduction unless the total exceeds $30,700. So if they have $15,000 of existing itemized deductions, say from state and local taxes, deductible medical expenses, mortgage interest, and whatever else, what happens tax-wise if they donate $5,000 to charity? The answer? No income tax benefit at all. Because the total won't exceed their $30,700 standard deduction. That doesn't mean they shouldn't give, but it's not going to help them save on taxes. Now, if you're over 70 and a half and have an IRA or inherited IRA, there's another way you can give to charity than simply writing a check. It's called a qualified charitable distribution, or QCD. Here's how it works. First, some rules. If you're 70 and a half or older, you can make a qualified charitable contribution of up to $100,000 each year from an IRA. If you're married and both of you are 70 and a half and older, and both of you have an IRA, you can each make a $100,000 qualified charitable distribution from your own IRA. Okay, second, any qualified charitable distributions you make counts towards satisfying your required minimum distribution for the year. However, when you make the distribution from your IRA, it must go directly from the IRA to the qualified charity. You can receive a check from your custodian, but it has to be made out to the charity, and it has to be a qualified charity. And third, here's the odd part. Even though you gave to the charity, you get no income tax deduction. So why would you do it? You get no deduction? Well, when you make qualified charitable distribution, the distribution from the IRA is never counted as income when you compute your taxes. So it satisfies your RMD requirement, but there's no income tax on the RMD. And that's why some people will do it. Now, let's suppose Albert and Shirley do what many retirees do. Albert takes his required minimum distribution of $5,000 at the beginning of the year, deposited it into his bank. Is he done with the RMD for the year? Well, he is. He's done with his RMD. Now, being charitable people, they donate $5,000 to charity. The end result, the charity gets $5,000. That's good. But by virtue of giving to the charity this way, their charitable contribution will actually cost them $6,200. Why? Well, the $5,000 went into Albert's checking account at the beginning of the year, and it has the tax cost. The couple's in the 24% tax bracket. Well, times 5,000, that's $1,200. So the $1,200 of additional tax that Albert and Shirley must pay when they file their taxes means the total cost of the charitable gift is $5,000 they gave plus $1,200 they give to Uncle Sam. Total cost is $6,200 because of the RMD taxes. Remember, the gift didn't impact their standard deduction. So it's just an income. It's just a gift. Now, what happens if they use a qualified charitable donation, the QCD? Instead of requesting a $5,000 distribution to the IRA to go to his bank account, he simply has the IRA custodian transfer the $5,000 RMD directly to the qualified charity. Now his RMD is satisfied, just like before. The charity has the same money they had now, $5,000. But Albert and Shirley are now in a better position. They gave $5,000 to the charity, and even though they got no deduction for the contribution, their IRA distribution is excluded from tax returns. Net cost, $5,000, not $6,200. That's a $1,200 savings. That's why some people do it. Now, we all know charity begins at home. So it's a natural question to ask, how does retirement tax planning figure in? It's a very good question. Because the government still wants its share of those tax-deferred assets when you pass away. And like we've seen, how you set things up really does matter, which leads us to key number 4. Organize your assets for your family's benefit. Estate planning still matters. Okay, enough about death. How about long-term care? We have an aging population. All of us have been touched by it, or will be soon. This is not a long-term care presentation I'm doing here today, but it's about retirement and taxes. But believe it or not, there are a number of tax breaks associated with long-term care insurance. For example, long-term care premiums may be deductible medical expenses at the federal level, possibly eligible for deductions at state level. On the other side, if you're receiving long-term care benefits, in many cases, those benefits might be tax-free. For instance, benefits received from a reimbursement-style policies, they're tax-free. In addition, cash benefit-style policies are tax-free if they don't exceed the higher of your actual long-term care costs or an IRS daily limit. I think it's currently around $390. Now, choosing how you pay for long-term care costs can have an impact on your state and on your heirs. Let's take a look. In recent years, non-traditional long-term care policies that blend together some long-term care insurance and life insurance have become popular. These are so-called hybrid policies. And often the first inclination of the insured here is to tap the policy, pay the long-term care costs. But sometimes that's a mistake. Let's take a look at Florence. A widowed woman who qualifies for long-term care benefits lives at home with an in-home care. Her yearly care costs are $60,000. Over 10 years, that's $600,000. And that's without increases. Florence's Social Security benefit is $20,000 annually, which covers her basic expenses, but not, obviously, long-term care. She also has $400,000 in an IRA, and she has a life insurance policy with a long-term care rider that'll pay $500,000 to Florence's children upon her death. Now, Florence could use up to $10,000 per month for long-term care costs. Any amount used for long-term care will reduce the life insurance benefits if she uses the cash value for that. Now, remember, this is just an example. It's not meant to represent any specific policy, but many long-term life insurance hybrid policies do work this way. Now, first, let's suppose Florence is infirm for 5 years and uses her policy to pay long-term care expenses. That's why she bought it, right? Of course she's going to do that. Now here, she pays very little or no income tax during this period because she'll still have such large unreimbursed medical expense deductions. The $500,000 policy pays out $300,000. That's $60,000 per year for 5 years. That means her kids will inherit tax-free life insurance of $200,000, the remainder of the $500,000 policy value after the deduction of all the money that went out to pay for the benefits. Now, in addition, her children will receive $400,000 in her IRA. Of course, that money will be taxable to them. Now, let's suppose Florence lives the same 5 years but uses her IRA money to pay long-term care expenses instead of using the policy. Florence still pays the minimal income tax per year because of her high medical expense deduction. Now the kids inherit a $500,000 life insurance policy tax-free, as well as roughly $100,000 of remaining IRA money, which will be taxable. Now, when you compare the scenarios, the ultimate net benefit is unknown, actually, because it depends on Florence's children's tax rates, whatever their tax rates are. But it's hard to imagine a scenario, really, where paying for her care with $300,000 of taxable money with minimal cost to Florence is not a better option than paying for her care with $300,000 of tax-free money. In the second scenario, we're preserving the tax-free money for the heirs and paying the long-term care with Florence's taxable IRA money. Okay. We're getting close to the end. You're probably thinking, God, this is a lot of stuff. How do I manage all this? It's a good question. Let's bring it all together. We started with a clear statement of the problem. Retirees often pay more in taxes than expected because of a confusing system that treats various income types differently and contains hidden taxes and penalties, but they all impact each other. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of your retirement savings before you retire. And we also saw that in those pre-retirement years, it's critical to consider your tax-deferred savings and start taking advantage of funding Roth accounts to fill your brackets, something you do through your early retirement years in your low tax years. Now, we also looked at Social Security and taxes, because the importance of couples having benefits oh boy, am I getting tongue-tied. Let me try this again for you. The importance of couples having benefit strategy that considers the surviving spouse is very important because we saw Medicare has its own tax-like structure, and it can push you off the Irma cliff. If you remember that, you can always rewind and go back and review it. And we saw the importance of signing up for Medicare on time, right in the middle of those early go-go years, because starting in your middle retirement years, you'll be confronted with required distributions, and we've seen the importance of planning on that. And then we saw the importance of setting up your assets and managing them during later years of retirement so you can preserve the most for your heirs and leave them with the most tax flexibility. Now, all of this leads us to the obvious solution to our original problem. Because your tax exposure will change throughout your retirement, you have to have a strategy that anticipates how and when you tap assets to cover personal expenses, understands the range of taxes you're going to face over those 4 stages, and manages the action so you pay the lowest tax rate possible throughout retirement. Well, if you've made it this far, It's probably because you're preparing to leave the accumulation phase, saving for retirement, and you're moving into the distribution phase of your life when you start actually reaping what you've been sowing all those years. We've seen the distribution phase is more complicated than working and collecting a paycheck. Managing your tax rate through the 4 stages of retirement is part of the challenge of retirement planning, and we've seen the cost of mistakes. Now, naturally, we want to be efficient with our savings, and there are no strategies to reduce the tax burden. But, well, I shouldn't say that. There are some strategies you can use to reduce the tax burden, but maybe not eliminate it. It depends what you're doing, how soon you start. People who start in their 50s usually have a big advantage over people who start in their 70s. Makes sense. But with many things in life, and this is no different, it takes education, it takes planning, and it takes professional advice. It's a lot to think about. The tax code is complex. That's why you should have your little board of directors. It doesn't change the fact that you need to plan. Well, if you're looking for professional guidance, this is a good place to start. If you don't have an advisor, I'm happy to help. Go to the Getting Started page of my website, indfin.com. There's a Getting Started page there, and there is the protocol. You can arrange an introductory telephone call, and you have to complete a priority review prior to the call. And you can email it or fax it or whatever. There's instructions on the page. But once I get the priority review and you've scheduled the call, we'll go from there. And during that introductory phone call, I'll have a better idea because of the review of what your issues are. And it'll give you a chance to find out everything about what I do, how I do it, how my practice operates. And hopefully we can be of some help to you. I hope this has been you found this instructional, and I hope my getting tongue tied hasn't messed you up too much. At any rate, thanks for watching, and I hope to hear from you soon.